They tried to bury silver in one session. They dumped it. They screamed bubble. They pushed the button that makes your stomach drop. And then silver snapped back and closed at 76. 28 up 5. It's 74% in a single day. That is the event. The trap didn't work. And now the people who sold in panic are the fuel for what happens next. I'm your host, and this is our channel. Now watch this. A real collapse doesn't rebound like that in 24 hours. A real top doesn't leave a green scar that big on the chart. When you see a violent flush and then a violent reclaim, you're not looking at random volatility. You're looking at a transfer. Someone forced weak hands to hand over positions to strong hands, cheaply, fast, and quietly. And here's the part most people miss. The headline candle is not the story. The closing price is the story. The low is where fear happens. The close is where control shows itself. Fact, silver closed strong. Interpretation, sellers ran out of ammo and buyers were waiting with a bucket. So let's slow down for exactly one breath and get clear on what just happened mechanically, not emotionally. Because we're not gambling, we're measuring. And if we measure the structure correctly, we stop reacting like prey and start thinking like hunters. First, we need to say the quiet part out loud. Paper silver and physical silver are not the same animal. Paper is a casino receipt. Physical is the metal that manufacturers, refiners, and real buyers actually need. During the flush, paper printed fear, but physical premiums stayed stubbornly high in multiple regions. Fact, physical pricing didn't mirror the panic move. Interpretation, real-world buyers were not persuaded by the paper story. That's the crack in the dam, because if the crash were real, physical would fold too. Dealers would cut premiums. Real buyers would step back. Instead, the physical market stayed elevated, and then paper sprang upward like it was yanked by a chain. That's not a bubble popping. That's paper being forced to remember reality. Now, ask yourself this. If the market was truly broken, why did it close at 76? 28 instead of dying near the lows? Who was buying into the fear? And why did they buy so aggressively that they erased a massive chunk of the drop before the day ended? Here's the mistake most people make. They see the red candle and think it's information. Most of the time in leveraged futures markets, it's liquidation. It's not new knowledge, it's forced selling. The difference matters because forced selling ends suddenly, and when it ends, price can teleport back to where it should have been all along. So let's define the monster in one line. Leverage is controlling a truck with a bicycle's brakes. It feels powerful, right up until the road turns. Then you don't slow down, you flip. In futures, traders control huge silver exposure with a small margin deposit. When price moves against them, their account doesn't get a polite warning. It gets a margin call. And margin calls don't negotiate, they liquidate. They sell at the worst moment because the broker is protecting the broker, not you. In fact, margin calls create forced selling. Interpretation, forced selling can slam price below fair value temporarily. Now picture a crowded theater. Someone yells, fire. Not because there's a fire, because they want the exit stampede. The first wave rushes out, knocks over chairs, blocks doors, creates chaos. Then the people who were calm walk in through the side and take the best seats for free. That's a bear trap, not simply price down then up. A bear trap is psychological warfare with a mechanical engine underneath it. The psychological part is the fear candle. The mechanical part is the liquidation cascade. And when a trap fails, it becomes rocket fuel. Because the trap only works if price keeps falling long enough for everyone to believe the downside is inevitable. When it snaps back hard, the bears who got cocky are suddenly trapped instead. Now the question becomes, who is trapped? Short sellers are trapped. Late bears who sold the break are trapped. Weak longs who got stopped out are trapped emotionally because the rebound makes them chase. And chasing is how they get burned twice. This is why a 5, 74% day matters. It's not a number, it's a signal that the trap sprung backwards. It says the flush hit a wall and the wall didn't move. Let's make this concrete. A flush down to the low is fear. A reclaim into the close is absorption. Absorption means real demand stepped in and swallowed the selling pressure. That demand can be speculative, yes, but when it shows up that aggressively, it usually means bigger players are building positions, not flipping for lunch money. Fact, the move back up was sharp. Interpretation, buyers were urgent, and urgency is the key word. Urgent buyers don't appear in dead markets. Urgent buyers appear when something is scarce, mispriced, or both. Now we need to talk about the paper versus physical gap without getting lost in jargon. Here's the simple version. If paper price says 76, but physical transactions clear far above that in multiple hubs, the paper price is a story. The physical price is the invoice. Why does that matter? Because you can suppress a story for a while. You can't suppress an invoice forever. Eventually, the story has to match the invoice or the system breaks. So what forces the story to match? Pressure, arbitrage, demand that refuses to be delayed, And the moment paper starts snapping upward after a flush, it's often the first sign that the story is losing control. Now here's the line we need to tattoo on our brain. The market doesn't move to punish the correct thesis. It moves to punish bad positioning. You can be right and still get wrecked if you're over-leveraged. You can be right and still sell the bottom if you have no plan. And you can be right and still freeze if you're watching headlines instead of structure. So our job is not to predict every candle. Our job is to read the battlefield. And the battlefield right now has three obvious features. One, the flush happened fast, which screams liquidity vacuum. When volatility spikes, market makers widen spreads or step back. Bids disappear. Price drops through levels like an elevator with cut cables. That's not price discovery. That's lack of buyers during a panic window. Two, the rebound happened fast, which screams buyers were waiting, not hoping, waiting. Like someone knew this discount was coming and had orders ready. Three, the close was strong, which screams control shifted. Sellers had the day. Buyers took the finish. Now, let's address a sensitive question. Was the drop engineered? We don't need a villain to understand the mechanism, but in a market dominated by leverage and stops, it doesn't take a conspiracy to create a trap. It takes one push at the right time into thin liquidity when positioning is crowded. Fact, crowded leverage makes markets fragile. Interpretation, fragility invites sharp flushes, and year-end windows make it worse. Funds rebalance, risk managers tighten, volatile positions get trimmed because accountants want clean books. That doesn't mean the metal changed, it means the paperwork changed. So if we're smart, we treat these windows like storms. You don't conclude the climate changed because you got rained on. You understand the season. Now, what happens next? This is where most people either get rich or get chopped into pieces. There are two paths forward that matter, and we should be honest about both. Path A, continuation. After a failed trap, the market is cleaner. Weak hands got shaken out, stops got triggered, forced sellers are gone. That means it can rise on surprisingly little new demand because the supply of anxious sellers has been exhausted. Path B, one more shake. Sometimes the market tries to test the floor again just to see if buyers are real or just tourists. That test can be violent. But a second failed flush is even more bullish than the first because it proves demand is persistent. So how do we tell which path we're on without pretending we have a crystal ball? We watch behavior, we watch closes, we watch speed. Here's the first thing we watch. Does price hold above the reclaim zone? When a market drops hard and then closes strong, there's usually a band where buyers defended. If price stays above that band, it tells us buyers are not letting go of control. If price falls back through it and sits there, it tells us the bounce was more fragile. Here's the second thing we watch. Do dips get bought fast? Strong markets don't give you comfortable pullbacks. They give you shallow dips with quick reversals. Weak markets drift, bleed, and let fear breathe. Here's the third thing we watch. Does volume show up on green candles? Volume is the crowd's footprint. If green days carry heavy volume, real demand is stepping in. If green days are quiet, it might just be sellers resting. And here's the psychological magnet, 80. Round numbers matter because humans are wired for them. When price creeps toward a round number, it attracts attention like a bright sign on a dark highway. Break it, and momentum traders pile in. Fail at it, and traders get jittery. Either way, it becomes a battlefield. Let's go deeper because this is where the chart becomes a lie detector. When price plunged, it didn't walk down. It fell through floors like a trapdoor. That's what thin order book looks like. In calm markets, bids sit at every level. In panic markets, those bids vanish. Market makers step back, spreads widen, and your stop loss stops being a seatbelt. It becomes an eject button. Then, right when the crowd expects the floor to keep collapsing, price snaps up. That snap is the moment bids return. It's the moment real buyers say, enough. Think of a stretched spring. You can compress it with force, but the moment the force stops, the spring doesn't politely rise. It launches. So we respect the wick. A long lower wick is the market admitting it went too far. It's the market printing evidence of rejection. Fact, the day rejected the lows. Interpretation, sellers hit exhaustion and buyers punished them for it. Now look at 76, 28 again. Not because it's mystical, because it's above where panic wanted to lock in. Panic wanted a weak close because a weak close becomes a headline. A strong close makes shorts sweat overnight, and sweating shorts become forced buyers. Here's the contradiction that traps people. If the thesis is strong, why is it so volatile? Because volatility is what happens when a market is tight and leveraged at the same time. Tight markets don't glide, they whip. So we watch one ugly tell. Do pullbacks get met with bids, or do they drift like a wounded animal? Quick rebounds, signal strength. Slow, heavy tape signals, caution. And keep your eye on the gap between screen price and get it in your hand price. If that gap stays wide, it's a warning flare of pressure building behind the curtain. So let's make this personal. What would make you change your mind? If price tag's 80 and holds, do you believe the trap is fully dead? Or do you think we get one more brutal flush first? Drop your answer in the comments because our community thinking is a weapon. Now we need to build the trust framework into this analysis because certainty without proof is how people get scammed. Fact, silver closed at 76.28 with a 5. 74% day. Fact, the move was fast and violent. Interpretation, this looks like absorption after a liquidation cascade. Likely, the selling was mechanical, not fundamental. Possible, there could still be more volatility, including another flush attempt. And here's the one-line disclaimer, natural and real. This is educational. We manage risk. Now risk. This is where most of the internet lies to you. They either scream to the moon or scream it's over. Neither helps you. We need rules that keep us alive. We stay calm and stay liquid. Don't let leverage decide your emotions. If a $5 move can wipe you out, you're not investing. You're sitting on a ticking bomb. Separate the asset from the vehicle. Physical metal behaves differently than leveraged paper contracts. Paper can get whipsawed by margin rules and liquidity vacuums. Physical tightness shows up in premiums, delivery delays, and persistent bids. Don't confuse volatility with thesis failure. Volatility is the weapon. Thesis failure is when the underlying demand collapses, premiums vanish, and buyers disappear. That is not what a violent reclaim suggests. Now, let's talk about why the reclaim can accelerate the next leg up. This is the part that makes traps so dangerous for the bears. When price drops, new shorts pile in because they smell blood. They sell into the low, convinced they caught the breakdown. When price reverses, those shorts are instantly wrong. Their stops are above. Their pain grows as price rises. At some point, they have to cover. Covering means buying. Buying adds pressure. Pressure pushes price higher. Higher price forces more covering. That's the squeeze spiral. A failed bear trap is like pulling back a slingshot and letting it go. The energy doesn't disappear. It transfers into motion. So if we see follow-through above the reclaim zone, and if we see attempts at 80 that don't get slapped down, the squeeze narrative strengthens. Not guaranteed. Strengthens. Now, what about the physical gap? Here's the key logic. If physical stays elevated while paper tries to drift lower, someone eventually steps in to capture the spread, if they can. But if they can't, because metal is hard to source, the gap persists. And a persistent gap is a sign of stress in the system. Stress does two things. It increases volatility, and it attracts bigger capital, because big capital loves broken structures. Broken structures create asymmetric trades. This is why we don't ignore premiums. Premiums are the heartbeat. Spot is the headline. If spot drops, but premiums stay high, the drop is often paper noise. If spot rises and premiums rise too, that's real scarcity getting louder. So what do we do right now as a community with this information? We don't chase. We don't panic. We build a plan. If you're already positioned, the move validates the idea that dips can be traps. That doesn't mean never take profit. It means don't let fear be your exit strategy. Let structure decide. If you're underpositioned, understand this. Structural bull moves don't send you an invitation in the mail. They slam higher when you're waiting for the perfect entry. So instead of waiting for the price, we scale. We build exposure over time so we're not paralyzed by one candle. If you're trading, respect the environment. Tight stops in a volatile market are a donation. Wider stops require smaller size. Smaller size requires patience. Patience is the edge. Now let's address the emotional wound. A lot of people sold during the flush. If that's you, don't beat yourself up. That's what traps are designed to do. They don't trick smart people by hiding information. They trick normal people by weaponizing timing. But here's the hard question. Will you let the same move take you out twice? First you sell the low, then you chase the high. That's how accounts die. So we do the opposite. We think in scenarios. We define what we need to see. We act when the market proves itself, not when our heart rate spikes. And here are our three main takeaways. Only three, because depth beats overload. Takeaway 1, the flush and reclaim suggests forced selling got absorbed. The trap likely failed. Takeaway 2, the paper market is being pulled toward physical reality, not the other way around, and that tension creates opportunity and risk. Takeaway 3, the next move depends on behavior around the reclaim zone and the magnet at 80, and our job is to watch closes, speed, and demand footprints. Now, one more retention beat, because we need to keep our eyes forward. If we're wrong, where will it show first? It will show in the close. It will show if price loses the reclaim zone and stays heavy, and if physical premiums finally crack. That's the early warning. Not a scary headline, not a tweet. The close. And if we're right, where will it show first? It will show in repeated dip buying, in strong closes, and in 80 turning from a ceiling into a floor. So here's the move. Subscribe now so you don't miss the next update, because this market is moving fast and we're tracking it with you, not at you. And drop this in the comments. Do we break 80 before we see another flush attempt? Yes or no? And what's the one signal that would convince you the trap is truly over? Because one thing is clear. They fired the fear cannon. It backfired. And when the market shows you a failed ambush, you don't turn your back and walk away. You tighten your grip, you watch the exits, and you prepare for the next chapter. Because the next chapter is where the real move usually begins.